All right, let's get right into it. Today, we are going to break down a really powerful trading setup. It's called the 15-minute bear. And what we're going to do is show you exactly how traders can use this combination of momentum and, pure price action to try and spot a market top basically before it even happens. So you've seen this a million times, right? A market is just ripping higher and that FOMO, that fear of missing out, it's almost overwhelming. But what if that whole rally is actually a trap? Well, that's what we're going to do. We're going to treat this like a crime scene and hunt for the clues that tell us a reversal might be just around the corner. Okay, first things first. Let's really dissect this trap. To catch the bad guy, you've got to understand how the crime works.
So this whole setup, it's called a bull trap. And it is a classic move. You see a market that looks super strong, and it just sucks in all these optimistic buyers. But what's really happening is it's a failed auction. And those buyers who are late to the party, well, they're about to become the fuel for a really sharp move down.
You have to think of it like a psychological battle. On one side, you've got retail traders, driven by that FOMO, just chasing the price higher and higher. But on the other side, you have the institutional smart money. And they're looking at this saying, this is getting way too expensive. And they start selling, unloading their positions right into that buying frenzy. So, what's the very first clue we should be looking for? The first sign that this trap is being set? Well, it is all about context. The environment has to be just right for this reversal to happen. And our first piece of evidence, it helps us read that environment perfectly.
And that piece of evidence is the Relative Strength Index, or RSI for short. The easiest way to think about it is like a speedometer for the market. It's not telling you what the price is, but it tells you how fast the price has been moving. And that's absolutely key for gauging momentum and spotting when things are getting a little extreme.
The magic number we're watching for? It's 70. When the RSI, usually on a standard 14-period setting, when it pushes up above 70, that's the signal. It's telling us that the asset is statistically overbought. It's basically a big flashing warning sign that all this buying pressure might be running out of steam. And this rubber band analogy, it's honestly the perfect way to think about it. Now, listen closely, because this is important. An RSI above 70 does not mean you should just sell right away. No way. A market can stay overbought for a long time. What it does mean is that the rubber band is being stretched and stretched and stretched. The tension is building, and the more it stretches, the more potential there is for a really violent snapback.
I love this quote. The RSI is the judge. It's the one that surveys the whole scene and says, yep, the conditions are right, the environment is ripe for a reversal. But the judge doesn't carry out the sentence. It doesn't pull the trigger. For that, we need our second clue. We need the executioner.
All right, on to our second clue. And this is the smoking gun of the entire setup. This is the visual proof, right there on the candlestick chart, that the trap is ready to spring. And that smoking gun, it's a specific candlestick pattern called a shooting star. And when this one single candle shows up in the right environment, man, it tells a whole story. It's a story of a fierce battle between the buyers and the sellers, and it's a story where the buyers made a big push and were just completely, totally rejected. Okay, let's get into the nitty-gritty here, because the details are absolutely critical. First, this has to show up after an uptrend. Then, look at that long upper wick, that tail on top. It has to be at least twice as long as the body of the candle. The body itself? It's got to be small, and it needs to be way down at the bottom of the candle's range. And you want to see little to no lower wick at all. Now, the color? A green body is okay, but a red body? Oh, that's a much stronger sign that the sellers are in total control. And this right here, this reframes how you should look at charts forever. This isn't just some random pattern. It's a story. It's a narrative of failure, all packed into one, say, 15-minute candle. That long wick you see? That's the ghost of the buyers who tried to charge up the hill, ran smack into a wall of sellers, and got thrown all the way back down again. It's a picture of defeat. Okay, so let's recap. We have our two key pieces of evidence. One, an overbought environment, thanks to our judge, the RSI. And two, a clear signal of rejection, our executioner, the shooting star. Now that we have the clues, let's get into the protocol. How does a trader actually act on this information?
And the rules for execution are, well, they're precise and they are not negotiable. Step 1, You mark the battlefield. That's the absolute high and the absolute low of that shooting star candle. Step 2, you do not enter the trade until and only when the price breaks below the low of that candle. That's your confirmation. And step 3, the most important rule. You place a hard stop loss right at the candle's high. If the price goes back up there, your theory was wrong. You get out, end of story.
Okay, now we get into something a little more advanced, but it is absolutely critical to this strategy's edge. It's about the tool you use. See, you could just buy a put option, right? Bet on the price going down. But this strategy is very specific. It says to sell a call option. So what's up with that? Why do it that way? The answer is something called the seller's edge. See, when you sell an option, time itself becomes your ally. There's this thing called time decay, or theta, and it basically means that every single day that passes, the option you sold loses a little bit of value, which is profit for you. So you can win if the price drops, sure, but you can also win if the price just goes sideways and does nothing. The person who bought the put option, they're in a race against the clock. They need the price to drop, and drop fast. The bottom line is, the call seller just has more ways to win.
And finally, which exact contract do you sell? Well, the protocol is very clear here too. You sell the call option that has a strike price closest to the high of that shooting star candle. This is what's called an at-the-money option. And the reason you pick that one is simple. It has the most time value packed into it, which means it has the most premium for you to collect as time ticks by. It just fits the strategy perfectly.
So let's bring this all home. The most crucial point of all is this. Having all the clues, knowing the protocol, that's not enough. That's not the real edge. The real lasting edge in trading comes from one thing, the discipline to follow the rules. Every single time, no exceptions. And I want to leave you with this really powerful idea. That discipline we just talked about, it is so important because when this pattern fails, when the price breaks above the high of the shooting star instead of the low, it isn't just a loss. A failed signal is a signal in itself. A failed shooting star is telling you something incredibly important. It's often a sign of a massive breakout to the upside. It's screaming that the buyers are even more powerful than you imagined, and it is your cue to get out of the way. So think about that. What does that tell you about where the real power in the market truly lies?